Thank you for joining us for another MyWealth webinar. My name's Jeff Hunter. I'm a senior portfolio manager at Canaccord Genuity. Also on the line are our lead senior advisors, Raheem Somani and Dave Townshend. For more information about our team, our process, please visit mywealthmanager.ca. With that, today we have Ben Fawcett. Ben Fawcett is our lead portfolio manager and VP of Investments and Advisory Solutions at Canaccord. He's got a pretty extensive background. He's got more than 2 decades of investment experience, recently coming over from Mackenzie, where he managed over $3 billion in assets on the institutional side. He's got a really strong track record and a pretty repetitive process. We'll learn a little bit more about it, but as many of you guys know, there's a lot of things going on right now. I even joke, my shirt says all you need is love. It's actually a Beatles shirt, which I thought was kind of appropriate for the call today. But we have Ben here who can help answer some of those lingering questions. I know a lot of people have had it there. The attendance and RSVPs are pretty overwhelming, so I think it's a very topical. It's very topical at the moment. So Ben, with that, can you just tell us a little bit more about yourself and what brought you here, why Canaccord, and what drives you to perform over that long time period?
Perfect. Well, first off, thanks, Jeff, Raheem, and Dave for hosting this, and thanks to the audience for taking your time out of lunch today. I'll start with the second part of your question. What drives me is passion for the market. It's curiosity. I find it fascinating, and it's one of those things, every Sunday I'm eager to get back in Monday and see the markets open, and I get to study companies and the world, and just huge curiosity. As far as my background, started off actually in the UK on the quantitative side, building factor models, partly on a hedge fund, partly for a bank. Came over to Canada 20 years ago and worked Canada Life, where I built factor models for the Canadian and US market, basically repeated what I did in the UK and Europe. And from there, as I became lead of sort of multi-billion-dollar portfolios, these were concentrated equity portfolios, had to go really, really deep. You've got 30 stocks and very significant positions, and did a decade plus of really in-depth fundamental work. So what I have is sort of a quantitative background looking at some of those numbers, as well as sort of deep fundamental understanding of every sector, every industry, and can really dig into the companies. And that's what I did at Canada Life and Mackenzie, again, running mutual funds, pension money, insurance money, variety of different aspects there. What brought me over here is actually the process that Kevin Vandermeer had set up. He was money manager at RBC, and again working between a quantitative process and a fundamental process. What I love about that, it adds huge discipline. You learn a lot over 20 years, a lot of things probably that you don't need to know, and the reality is you also develop a lot of biases. And where I love the quantitative side is it keeps me clean, sort of thing. It makes me question and brings me back to those fundamental aspects that I look for in companies and ask the question. So I can compare, sort of tie those two aspects back together. So yeah, a bit of a long-winded answer, but there you go, Jeff.
Love it. Well, why don't we just start off from one of the major things that we come across, the outlook for the Canadian economy, potential leadership change. What are the impacts? Where do you see us? Can you give us some light onto that?
Yeah, sure. Couple of areas. One, as far as the Canadian economy, the way I define it is we've been sort of bouncing along the bottom probably for a couple of years now. It's been, not quite a recession. Some would argue it has been. And I think a lot of that has to do with a misalignment with our biggest trading partner, the US. And I've got some slides here, so I can run through this, and maybe I'll do it after this question. So basically, we had this misalignment, and as a result, the Canadian economy to some extent has suffered over the last 5+ years. I'm actually quite optimistic as far as the Canadian economy, because I think what we can change, or the changes that we can put through will actually make a significant difference. You know, at the end of the day, Canada has huge resources. It's got a dynamic population that's highly well educated, and it's one of the biggest economies in the world of 40 million people. So there's a lot to work with there. We just need to change some of the policy. And, you know, the sort of tariff crisis, I think, could actually be that stimulus that gets that going. Perhaps maybe I'll just jump through the next few slides for a few minutes and I'll touch on some of the tariff aspects and then we can get through some of the other questions. I'll sort of take a step back as far as how we actually getting a lot of questions on, you know, what's Trump's motivation? What are the impacts for Canada and the rest of the world? First way I'd look at it is what's Trump's playbook? Because there's a lot of headlines, there's a lot of noise. So you sort of look at what's the art of the deal? As Trump basically wrote. So the first step he always comes out, and we've seen this a number of times, is go big and beautiful, basically ask for everything. Greenland, tariffs, making Canada a US state. The second part is just dominate the narrative, full media attention. Then he
Enwick, buy order of 100,000 Netramark.
There we go. And then from that point, maximize leverage, basically apply everything you can, be it tariff threats, military invasion in some case, nicknames, you name it. But when it comes to actually negotiating, you can be pretty pragmatic, and we've seen this in Trump term one. We've even seen it in some of the sort of initial moves at this stage. There's a further step I'll add in there, which is a rug pull, and Canada is probably about to receive that one, where he'll then negotiate. You think you got an agreement potentially, and there'll be a final rug pull. And after that, then there'll be a final negotiation, at which point you'll need deliverable wins. Often those aren't significant. It could be a photo opportunity, soundbite. I mean, we saw this with the North Korean negotiations where, you know, Trump actually went over there and not much came of it in the end other than photo ops. So that's sort of the framework of how we deal with, you know, what's going on right now. Move to the next slide, slide 3. The next question is, what does Trump generally want? Two parts here. What does he want for Canada? And then what does he want globally? I'll start with the global standpoint. Tax cuts are probably, from what I can tell at this stage, his number one objective. And they were probably his biggest objective in his first term. The big constraint he has right now is Biden didn't leave the books in great shape. So if he wants to get these significant tax cuts, which could add up to, you know, I've seen estimates of up to $4 trillion, you're going to have to generate some more revenue, and you're going to have to cut spending. So that's where Elon Musk and the Doge comes in, and we're hearing lots from that standpoint. But there's a lot of constraints from that standpoint too. And the reality is the majority in the Congress is not that significant. And a lot of Republicans don't want further debt spending. So that's a huge constraint from that standpoint. The second is manufacturing jobs. This is a huge part of his platform. It was in term one, was again in term two. The constraint here is we've had a lot of inflation. US consumers are tired of inflation. The chairman of the Fed has said as much recently, and Trump's very aware that if you start seeing inflation from tariffs or bringing jobs back to the US, which could be inflationary, there's going to be consequences. Third part is national security. On one hand, he wants to reduce spending so he can have his tax cuts, but at the same time, he does want stronger border controls with the southern border with Mexico. And from the Canadian standpoint, I think it's less about the actual border, and I think it's about the Arctic sovereignty. You know, as you get more accessibility to the Arctic regions of Canada, ships can go through there now, and there isn't much military presence, basically none. And you're seeing countries like Russia and China start to make moves in that region. So I think that's a big concern to the US because it's just too close to home. And, you know, Canada falls in from that standpoint. The final would be resource security. From an energy standpoint, a hard push on drill, baby, drill with domestic energy production, strategic metals, especially some of the rare earth metals that are critical. Most of those nowadays come from China. And then there's water, which is increasingly becoming a bigger and bigger factor. And I think we'll be talking about that more over the next few years. So that's what Trump's after. If we move to slide 4, what does he specifically want from Canada? I've sort of touched on a couple of those, but tariff revenue. He needs revenue so he can fund the tax cuts. The reality is, once you take oil out of the trade deficit the US has with Canada, and I take oil out because we send it down there at a big discount. So it's actually huge benefit for the US, and for them to produce that is going to cost more than off existing infrastructure that's in Canada right now. If you actually look at manufactured goods, there is no trade deficit. So he can tariff those goods, but at the same time, there'll be counter tariffs. So there's puts and takes there. The Canadian job side, I mean, this is where auto manufacturing example like that, those jobs he'd like to be down in Detroit. The reality is, to move that again is tens of billions of dollars of capex, years, and wages in Canada are pretty competitive. I mean, partly because the healthcare costs are significantly less. So a move like that would ultimately be inflationary, which leads back to the initial constraint I mentioned. The other area is Arctic security, and no question here. I think Canada needs to do more on its defense spending, in particular, from that standpoint. So that should be an easy one for Canada to do. And finally, strategic minerals and water. This area Canada should be investing in more anyway. Reduce regulation, promote investment. These are strategic resources again, so it's a lever Canada should be leading on. Water is a much more complicated issue. There are a number of agreements in different regions of Canada for specific waterways. It's always been held off, say NAFTA or the USMCA. Once you start that negotiation, it can be difficult to remove it. So that's going to be a more complex issue that I think the US is going to increasingly be interested in. And there'll be a lot more talk and study from that standpoint. So just moving to the sort of final slide on this, the issue as far as, how do we resolve this crisis? So we have an idea now what Trump wants at this point. I think there's a couple of things you need to keep in mind that are probably critical here is, throughout history, countries have tended to trade with their closest neighbors, and that makes sense because generally the things you trade are heavy. You have cultural and relationships with neighboring countries. So it makes it a lot easier from that standpoint. The reality is, we have this huge border and we need to trade with the US. They need to trade with us. We don't have a lot of other options as far as neighbors to trade with. So I think at the end of the day, it's in the interest of both sides to come up with an agreement here. And I think that will sort of lead the thought process of negotiating partners once all the posturing subsides. The other consideration is, like I said, Congress right now has a Republican majority, but it's very slim. There's a number of 10 or more US states that Canada is their majority trading partner. Each of those has a couple Senate votes, and it's got a number of votes for the House as well. So that's significant leverage on Trump as far as how far he can push, because he needs their votes, and he can push those senators and congressmen to a certain point. But only so far. So there's a couple of aspects there. Back to geography, though. At the end of the day, the US is our largest trading partner. We do have to be aligned with them to a certain extent, both on a policy standpoint and economic standpoint. It's too easy for people and capital to flow across the border. I can remember 10 years ago, before the first Trump corporate cuts, where you actually had companies doing what was an inversion, basically re-domiciling from the US to Canada because corporate taxes were lower here. So say, take Waste Connections. One of my favorite companies in Canada was actually a US company that re-domiciled to Canada. That doesn't happen anymore because the US corporate tax cuts are much lower now. So I think that's one area where Canada needs to realign. The other one would be regulation. Doing business in Canada is far more difficult than the US. So these are all sort of opportunities. And the way I look at it is, don't waste a crisis. Basically, a crisis can be an opportunity to push through the big structural change, make the changes that need to happen to improve Canadian competitiveness. So I'll just sum up very quickly by touching on the sort of key areas, but there's a lot more. Deregulation, I've mentioned, that's a key area. Corporate and personal taxes need to realign with the US, or you lose investment in the best and brightest. Energy policy, I mean, this is where the ball's really been dropped for a long time. You need access to tidewater for your energy, be it Northern Gateway, be it LNG investment on the West Coast. Interprovincial trade barriers, again, 40 million people in Canada, and we don't treat that as one big, large, efficient economy. So huge opportunities there. And finally, just need to be pragmatic, probably. There's a lot of special interest groups that are dictating policy and have for decades in Canada. And I think there's opportunities there to, tap away at some of those areas to make the economy more productive and make it more efficient. So, Jeff, that's a very long-winded answer, but I wanted to give a bit of sort of precursor as far as, what can Canada do? So as far as that optimism, yes, Canada is not in the best position right now. If we were to have 25% tariffs, that would be bad. The Canadian dollar would go to 65 cents or less. You'd have recession. You'd have to have huge fiscal spending, which is possible. We went through COVID, but at the same time, I do think that's not my base case to some extent. And with the leadership change that we're going to get in Canada, likely over the next few months, and then a federal election, there is potential to get greater structural changes, which actually give me a lot of optimism from a Canadian standpoint as we go over the next year or two.
Awesome. Appreciate that. So with all that's going on, can you just elaborate on your investment approach? How do you differentiate your approach in identifying undervalued opportunities, especially with all that's going on right now? How does it help you adjust the portfolio, and how quickly do you respond?
Sure. Couple of areas. One is maybe Matthew, and he's just got the slides. If you don't mind moving to the investment process slide. I'll just touch on the process quickly. A number of aspects there is, how do we pick stocks, and then how do we build a portfolio to manage risk? I touched on some of the aspects as far as how we build a portfolio. So there's a quantitative side, and then there's a fundamental side. Quantitative side, we're looking at sort of key attributes of a company, be it quality, so profit margins, growth, and then we're also looking at valuation. We're also looking at sentiment. We're looking at price sentiment as well as the actual momentum in the company's earnings. Key aspects that I look for in a company for long-term outperformance, and that's where we get the discipline for. The fundamental side then, again, use all those years of experience to dig through the company's kind of thing and actually make sure those numbers make sense and that we have a good quality company that's growing and we're not paying too much for it, because the valuation does matter. So that's how we pick our stocks. You touched on the valuation side, and not the valuation side, how do we manage risk in an environment like that? And that's where the portfolio construction risk management is absolutely critical. Spend a lot of time thinking about this. The portfolio is designed to be all weather in the sense that we're not trying to be value style or growth style or have it work in a certain type of environment. We're considering all those different aspects, and then we're putting it into a portfolio where we have broad diversification. So if you look at the actual stocks, we've got stocks in every sector. We'll even break down some of those sectors, make sure we've got insurance companies, we've got banks. On energy, do you have pipelines, do you have producers, integrateds? Try and find the best of all those different groups. What that means is that the portfolio can work in any type of environment, any macro regime, and it sort of gives you more of a consistent, a steadier ride as far as the performance over time. On top of that, then, so there's the sector positioning. There's also how we pick stocks. So let's say there's 40 to 50 stocks in a portfolio. I don't want 2, 3, 4, or 5 of those to determine the outcome of the portfolio by having huge positions in them. If I've got 40 stocks in a portfolio, I want they're all there for a reason, and I want each of them to have a crack at adding performance. So that's where we control the position and the sizing of each of those positions to make sure they're not quite equal. Well, it makes adjustments here and there for volatility and other factors, but to make sure that the portfolio isn't reliant on one or two position or a handful of positions. So when we're dealing with an environment like this, where there's huge headline risk and, every Sunday evening there's new headlines and it's how we're going to deal with that this week, there's a broad portfolio that I don't expect to swing one way or another with those. And then we can make sort of smaller adjustments, which I can touch on.
With that, you talk about quantitative, and you recently published a white paper on your process. Talked about the Federer process. Can you explain what that is and how
Yeah.
that's
Yeah. I don't know if you saw the white paper. It's 70 pages of a lot of data. So I'll forgive you if you didn't go through every page of it. This was an update that's sort of a year in the working with the whole team here. I'll touch on the Federer process. So it sort of comes down to a disciplined, steady approach to investing, which is at the core of what I've been saying and what we do. It was a recent sort of presentation where Federer pointed out that despite the fact that he won 80% of his matches and won a huge amount of Grand Slam titles, on any given shot, there was only a 54% chance of winning that individual point. So basically, it felt like a coin flip on every point he played. But by consistently having that 54% win ratio, he won 80% of the matches. And like I said, a lot more of the Grand Slams. It's interesting because there's data I've seen as far as what a successful portfolio manager looks like. And they have a very similar win ratio. And if you actually look at the stock market, 54% of trading days were positive from 1950 to 2023, which resulted in 74% of those years showing a positive market return. So it really comes down to consistency rather than huge volatility, up 10%, down 10%, just consistently going for singles. And over time, that builds up into strong performance. And that's where the quantitative discipline I've talked about with our models really make sure we come back and say, are we doing what we say we're doing, questioning everything, and then the portfolio construction, how we constrain that portfolio to make sure we don't get excessive volatility and we can kind of stick to our steady game.
And then one more part on that, policy risk within it. How do you manage it?
Again, there's two aspects. Partly it's the portfolio. Basically, the way I always think about it, Sunday night, huge announcement, tariffs are coming or something like that. If the portfolio isn't in great shape for that thing, it probably means I've done something wrong before that. I want to build a portfolio, like I said, that can handle a bunch of different macro regimes, different valuation environments, different markets. So that's all the construction, and that happens before. So when you hit areas like some of the policy risks we're looking at, there was a note I sent out after the initial mention of Trump's 25% tariffs. And I said, these are the implications potentially. And then obviously a big one being Canadian dollar will depreciate significantly. So you want to own Canadian companies that have significant US operations, significant US revenue. And there's a lot of them actually, be it Waste Connections, which I mentioned, Constellation Energy. Most of the energy producers, the gold producers, all those are priced in US dollars. So there's a lot of companies in Canada that would benefit in that situation. Then there's other more nuanced aspects as far as who would actually have to pay those tariffs and regulatory changes, etc. Because it is a broadly sort of, because the way we construct the portfolio, we don't need to make wholesale changes. If I come in Monday, there's a good chance you're going to get whipped when on Tuesday they announce an agreement anyway. And that's part of it. On the margin, we have had to make changes. For example, US defense stocks, they were great in Trump's first term, but this time he's really going after US defense spending. On the other hand, on the international portfolio, European defense stocks are looking really good because Europe's going to have to spend a ton to to increase their defense. So on the margin, there are places where we sell US defense stocks, buy European defense stocks, for example, and there's other examples like that.
Perfect. Well, we've been hearing a lot about American exceptionalism. Speaking of the US, what's your outlook for it, especially compared to Canada, Europe, and Asia?
Yeah. Yeah, when you put it that way, I mean, the reality is I'm still probably would put two aspects, I'd say. I'd look at it growth versus the valuation aspect. From a growth standpoint, I still really like the US economy. Growth is doing well, and you've got a Federal Reserve that still has rates of 4% as wants to cut if it gets half of an opportunity too. So US growth actually looks pretty good. Deregulation is going to help. There's a lot of noise right now, lower corporate taxes. So US growth looks good. Canadian growth, like I said, hasn't been good, but I can see a pathway in line of sight for that to improve. And I think that will get reflected in valuations of Canadian stocks, which are low right now. So once the market starts to say, yes, Canadian growth can improve, you'll see those stocks move up to that. US stocks from valuation standpoint, on the other hand, is where the challenge comes in. There's a lot of good news priced in, and we've seen that with earnings this quarter where, companies really have to put up good numbers, otherwise the stocks get hit to some extent. So from a US standpoint, I like companies that can grow in that backdrop and can justify the valuation. As you go to Europe, we've got an international fund that's up almost 10% just year to date. You've had huge discounts on the valuation side, but at the same time, Europe does have structural issues, be it France, Germany, UK, and the earnings growth just isn't significant, but you're getting stocks a lot cheaper. So there's opportunities actually I really like there. Japan, I think, is turning the corner. If I look at China, that's a tricky one right now. We've certainly seen Chinese technology stocks take off. I think we're going to get some stimulus at some point once they have more clarity as far as, what the policy will be with China. Trump's even talking about he's happy to do a deal with China, which actually wouldn't surprise me. And that could be hugely positive for Chinese equities. So I'm actually starting to get more interested in Chinese equities at this standpoint. If you look at more developing markets, places like Brazil, not interested right now. Other places like Malaysia, Indonesia, Philippines, seeing a lot of capital investment in manufacturing there. If you see China start to pick up, I think those parts of the world could get interesting. So it really does come down to some places have growth and matching that with valuation for an outlook. But yeah, I'm certainly still invested in the US.
Well, just while touching on the US side, say, I know it's not your base case, but say they impose pretty significant US tariffs on Canada. How would you position Canadian stocks in that situation? And then the second part is, how would you position US holdings if they were to impose these significant global tariffs that are threatened?
Yeah, hopefully we don't get to that, but I mean, we're drawing up against the next deadline, so we'll see. And the market may move that way in the short term before it has more clarity anyway. From a Canadian standpoint, I was saying a lot of Canadian companies actually have significant US dollar revenue exposure. And that's where you want to focus because Canadian economy would hit a really rough patch if we had significant tariffs. So Canadian companies like Constellation Software that have US operations and US revenue benefit from US growth as well as just the depreciation of the Canadian dollar. So there's a number of areas. Some of the banks have significant US operations. Like I said, any commodity company, barring there may be some issues on the energy side, they sell in US dollars where their labor costs tend to be in Canadian dollars. Gold companies tend to be good. A company like Agnico Eagle, where most of its mines are in Canada, Canadian labor costs, but sell in US dollars. And gold, particularly the uncertainty and the risk, I think is good for the gold price. So a few areas there. WSP on the industrial side, I'd avoid the rails, Waste Connections on the industrial side too. So you can sort of go through the list, but certainly a focus on the US would be a big area. The US would be the opposite, actually, where US dollar strength would be the result of global tariffs. As a result, you sort of want to focus on very domestically focused companies, be it some of the utilities, AT&T, you've seen perk up a lot, T-Mobile, even Verizon's looking strong. So some of those domestic areas, the banks are very domestic businesses in the US, select industrials like Republic. So I would focus on domestic players, domestic retailers, manufacturers.
Oil, big topic here in Alberta. Thoughts on your outlook for this sector, especially considering potential increase in tariffs? Again, not necessarily the base case scenario for much of, especially when he's told the Saudis he wants cheaper oil. But can you run us through the sector itself?
Yeah. I'd be very surprised to see significant tariffs come on the energy side, because this has always been an area where Canada should be doing more, either to get its oil to foreign markets where it wouldn't be discounted to the same extent. And there's also some national security issues there. But the reality is there's very little value add that happens as far as the refining side in Canada. Most of this is a raw product that goes down to the Midwest, and the value add happens in the US. So it's a gift to the US that way already. And so I find it hard to believe they would want to put significant tariffs on from that standpoint. As far as my overall thoughts on oil, yeah, I mean, you've got OPEC Plus right now with a couple million barrels they're holding off the market. Production has been pretty strong in non-OPEC regions, as has been demand. But the market's looking pretty balanced for that side. So I'm not necessarily looking for $100+ oil, but I think it's at these levels it looks pretty good. And the Canadian producers were definitely there. They spend a lot of capex on a lot of the oil sands operations, and the cash generation is amazing. So still invested in the Canadian equities in particular, less so on the US side probably.
It's Dave. I just wanted to ask a question.
Yeah, hey Dave.
Hey, again, thanks very much for your time. The idea that we're going to have a lot of major companies re-domicile to America, and is it the hollowing out of industrial Canada here? Are we going to see that? Is there enough incentive for the big people to move south?
Again, I think Canada has realized that it needs to do more to stop that happening, because you can't let that happening. I mean, GM, was talking about that in the media the last couple of days. The consequence of that would be severe. So I think Canadian tax policy, and Poilievre's talked about that. Carney's now talking about that in sort of slightly fluffy language, but I think there's a realization that we do need alignment. So I think before you actually saw that happen, you would get policy changes on the Canadian side. But it's certainly a risk. And again, this is the crisis that I think stimulates the change that has to happen.
Perfect. Now switching entirely different gears. Meg 7s.
Yeah.
2024, pretty impressive from a price appreciation. Still growth opportunities within them, valuation risks. Any touch on some thoughts there?
Yeah. Talking about American exceptionalism. I like these companies generally. I mean, they're amazing businesses. If you look at their profit margins, and consistently, we've never seen anything like it. They have huge platforms to generate tens or hundreds of billions in cash flow that they can reinvest and use a competitive advantage. A couple of key risks I see with them. One is when you're that big and you have to grow your top line by say 40 billion a year, that has to come from somewhere, and that's just not economic growth. So you need to be in markets where you can still grow, and there aren't many places you can do that. Cloud and AI would be that. So cloud and AI need to work, and that's a big question mark. I think they will, but the market's still unsure on that standpoint. The second part is, if we did get global tariffs, all these companies have 50+% of their revenues internationally. So a strong US dollar actually isn't good for them from that standpoint. And you could get consumer boycotts in Europe and other places. Not necessarily that easy to replace Google or Microsoft, but on the margin, you'll definitely see that threaten them. And the valuations are high. I'd argue probably not excessive if they can maintain their current growth rates. But if you really do start to threaten that, then it's a significant headwind at this point. So
DeepSeek announcement a couple weeks ago, although we did hear about it, rumors of that a few weeks prior. Just a pretty sharp reaction by the market, nevertheless. Will increased AI efficiency reduce the need for high-end chips like NVIDIA? Thoughts on that specifically?
yeah, I mean, there's two schools of thoughts. One is suddenly AI becomes far more efficient. And a lot of companies are already moving down that way. So, Meta had done a lot of work and their models are getting far more efficient. Building the initial ones is always more difficult. And then when you can work off those, you can be more efficient. So they did have some innovation, but it wasn't completely all new. The other side of that is you've just made AI that much more affordable. And does that just increase the implementation and adoption of AI? And that's probably the camp where I think this is an accelerant. So, it's going to increase productivity broadly in the corporate world because you'll get more adoption of AI. So overall, I think this just accelerates the process. We've certainly seen the Mag 7s report their quarters and not make any sign of wanting to decrease CapEx. Though, companies like Microsoft are probably well incented to, because the market's certainly been penalizing them for that. So I think at the end of the day, the build out continues as is. But AI adoption accelerates, which ultimately has more sort of implications for the market and productivity.
Well, leading into that, could lower energy consumption from these models reshape long-term infrastructure needs, investment in power and data centers? It's pretty substantial, the claims that they're making and the desires that they have and the resources that we have currently or they have currently to build out in that capacity. What are your thoughts?
Yeah, at the end of the day, when it comes to building electric generation, some of those huge spends, it takes time. You're talking hundreds of billions of dollars. There's regulatory issues, and it takes a lot of time. So to some extent, you need the technology to become orders of magnitude more efficient for it actually to have the desired effect. If I'm looking at electric utility, the reality is you just can't grow that quickly because you have to build a lot of big stuff that's expensive and takes a lot of time. So from a DeepSeek standpoint, I think that investment still comes as far as the electric infrastructure build out and the equipment. But I think we actually needed that efficiency that we're seeing because it would have become, you can only grow so fast as far as the infrastructure side of it. So this is a benefit to some extent. And the infrastructure, Capital Power would be one company that is building out nat gas electric generation capacity. And that's a name that has been hit. We've seen it with names like Vistra in the US. But I think in the end, that business model is still intact.
We got a question from the audience, and for those, there is a Q&A button at the bottom. If there's any questions, feel free to type them out. I'm more than happy to answer in the time given. But first one is, on the assumption that the tariff is negotiating ploy rather than a long-term policy, how long would a 25% tariff have to be in place before the Canadian economy really feels pain? Is it an immediate hit? Would that suggest an immediate recovery once the tariffs are dropped or reduced?
I think a couple of aspects here. One is the threat of this alone is stopping companies from investing in Canada, be it Canadian companies or foreign investment into Canada, which is part of the leverage that the US is trying to exert. So I think there's certain risks of just having this overhang right now. We're starting to feel the effects of that probably right now. As far as how that's going to happen, I think you'd see those tariffs come on, and then pretty quickly after that, you would see huge government spending. We went through COVID where significant portions of the economy were shut down for a year or two. It's not great for the Canadian balance sheet, but need be, you might see significant stimulus. You'd have to see significant stimulus to prop up areas of the economy that would be hit. But it wouldn't be instantaneous. Initially, profit margins of a lot of those importing companies would take that hit because you just can't restructure, say, the auto industry. It's incredibly complicated. So you can't just do that even in a year. It's going to take, years and years to build capital in the US and sort of restructure it and find other partners. So it wouldn't be immediate. I think the stock market would price a lot of that in pretty quickly. But at the same time, the stock market would probably know that, you know, this isn't something that can stay, because it would hurt the US significantly, and there'd be big consequences in the US too.
Perfect. Dave, Raheem, any comments, questions, thoughts?
Hey Ben, Raheem here.
Hey, Raheem.
When you look at the holistic view here of the Trump administration, and looking at all sorts of political sort of changes, most of the time it's not how it started, it's how it ends, a political term. And I think Trump is well aware he's a pretty good leash here for the first 120 days to, use his American backing to sort of tear down the models that have been built up over the last, decades. And from his vantage point and a lot of people's vantage points, they don't seem to work. But if you start to look at the underlying sort of situation, his calling card is to end the wars, end the spending. But then if you look at it, even today, they're trying to figure out how to give people $5,000 in DOG efficiency checks just to calm all the layoffs that they're trying to do to tear the government down a bit. So, when you look out 120 days from now, that's nice that he's going to do all this cutting. But then he knows he's going to have to do a lot of spending, and a lot of trade again. So when you look at it from a holistic point of view, there's a lot of threats going on everywhere. But we've seen this before, is it's a wait and see attitude, and then it's almost like a calm, and then what are you going to do for me? And I think if you see it, and you mentioned a couple key things here, is the Fed has a lot of leeway to help support Trump on the back end. And he's going to restructure, I believe, the government spending into tech and move away from just employing the broad masses. And I think what he's going to also try and do, and is great what you pointed out, was the whole Arctic Passage. I think he's going to try and leverage Canada into opening up more global trading channels that benefit the US. Canada can sort of create a tailwind. But do you see a lot of what I'm kind of playing out in my mind? This whole game of chess is just that. Nobody's made any moves yet, even though they're kind of edging on sort of getting things done. I think if you look at it, US manufacturing relies too much on global inputs to create the pricing pattern. This could end up badly if too many walls are put up everywhere else. You could have global trade circumventing the US, and China benefits long term. And so India benefits long term. So you can only play the playbook until everybody starts reading the plays, and then we all start looking at our own sort of situation like you suggested. And then so I feel the back end of this whole Trump presidency could actually be a very strong benefit for investors if he is just realigning where he wants to do all the spending and all the trade.
Yeah, I mean, a number of ways there. First off, when I look at this, it's the US already has huge military and economic influence, and it's very good at wielding that globally to benefit US companies and US interests. So to look at the current playing field and say this doesn't play to US advantage, I mean, the US has shaped a lot of this field already to some extent. And we live in a world where increasingly there's other players like India and China that are trying to vie for influence. So the US, on one hand, needs to work closely with its allies and friends, because, if you treat Colombia, for example, that was the first place the tariffs in a certain way, next time China comes knocking, they might be more receptive. Same with Mexico to some extent. And, 5-10 years down the road, you don't have an ally that you want or need, probably. So I think there's significant risks from that standpoint. It's very short term, but it does come back to this playbook, which is ask for everything, make a lot of noise, create some leverage, and then try and get out probably minor concessions, I think, at the end of the day. But there's significant risk to the US here, as in, reliable trading partners and allies and friends are going to say, we've got to be a little careful now. and we'll keep our options open going down the road because we just don't know what's coming. And that has huge implications as far as, US companies. And that would be the one threat I touched on there with some of the Mag 7 to some of these US companies. You're opening the door a little bit for foreign competition and, foreign upstarts to some extent. So it's a dangerous path for the US too. And I think there's significant consequences for the US too.
Two quick questions, kind of on the same sort of lineage. If there's one undervalued sector that you're keeping your eye on, 3 to 5 to 10 years out, notwithstanding all the tariffs and all the noise and all of the innuendo or variables that can help make money, what would that sector be? On the flip side of that, is there one stock that you look at out there, because you look at a lot of them, that you feel like you should own, want to own, and continue to own for the long term, that has one, maybe the moat, B, the technological advantage, C, the management perseverance? So one undervalued sector or industry, and one stock that, at the end of the day, whenever it gets cheap in the market, you want to add to.
Yeah. From an undervalued standpoint, going out 5 years is tricky because growth over time becomes such a big factor. So, something that may look cheap today, if it isn't growing, and I'd look at some of the Canadian telcos from this standpoint, you could say BCE has a 10% dividend yield or 9, whatever it is on a given day. But the reality is it hasn't grown in years, and I don't expect it to grow in the next few years either. And so a few years down the road doesn't look so great, where you can get a company. I think the market often underestimates that a company that consistently grow over time, 5 years out, you're dealing with a much larger cash flow number. You could be dealing with a cash flow number that's twice as big or 3/4 as large anyway, which changes the valuation profile. So I wouldn't give you a specific sector, but it's areas that I think can consistently grow. As far as in Canada, those nice steady growers that aren't necessarily cheap, there's a few I go to, sort of my standard ones. I've talked about Waste Connections. Again, not a cheap stock, but very consistent growth model, inflation proof to some extent. Assets are in the right places, and an M&A model that allows it to continue to grow. And it does that very consistently. Intact Financial, they just sweat the details on the insurance side, and they consistently win and consistently grow. Constellation Software would be another company that same sort of deal. They just consistently grow over time, and that allows the valuation basically to come down, allows the stock to go up to some extent. So there's sort of a couple of Canadian champions like that I tend to focus on. Dollarama would be another one, just an algorithm there that'll give you 12 to 15% annual growth between store growth, margin expansion, new price points. Just year after year, they continue to do that. So those would be the companies, steady growers, quality compounders is probably where I'd focus on for the long run. And then you can just leave those companies. And if you hit a recession, no problem, because they'll survive. They'll be there on the other side. And during that recession, they probably bought out some of their weaker competitors or just took their market share, and they come out stronger.
People touch upon Deckers. They've had recent 4-quarter announcement, but how it fits in the process, thoughts, just to give people a little bit better sense of how you vision things and how you view things, both on the shorter and longer term.
Yeah, I mean, this one's been very disappointing recently. Was a holding for a while, had a great start. Just for the audience, they the manufacturers or retailers of UGG shoes, which has sort of revitalized the brand and come out with a lot of new lines and lots of store profile. They also own Hoka running shoes, which have become a bit of a fashion brand, but they sort of dominated in the athletic segments as well. And now you're seeing standalone retail stores in a lot of the big malls around. And both of those brands have actually been growing really nicely and consistently for a while, until they had their last quarter where They mentioned some inventory issues and suggested the next quarter or two could be a bit softer, and the markets actually punished them hard for that. And we've seen that with a lot of companies right now because expectations in the market, there's a certain overhang as far as sentiment right now, just with some of the macro and geopolitical issues, but also because valuations are fairly elevated. We've seen stocks come off that haven't actually delivered. So if I look at the earnings, I try not to reflect too much on quarterly earnings unless there's a structural change in the company. And if I see that, I don't care. Leidos was an example on the defense stuff. We owned that, it worked well, came off, and you can see a structural issue. So sell it no matter where, it's time to get out kind of thing. If it's a quarterly issue, I can look through that. If I look at where estimates for the next year or two, do I see any structural changes? And that looks fine, then I'm inclined to hold through any downturns in the market. There is a point though when you do have to acknowledge that maybe the market's picked up on something that you just don't see. And that's when you stop asking questions and you just say, I'm going to trim my position. We did that with Arista Networks recently. Decker's, I'm getting to that point now where the pullback's been sufficient that, you know, are we missing something? You always have to have humility in this business. And at some point, like I said, no one stock makes a portfolio. We keep our positions constrained to some extent. So at any point, you know, if we say there's something else going on here, or we're going to go and invest somewhere else, it's just too much uncertainty, I will either trim the position or just take it out. And so that's the point I am with Deckers. My base thesis right now is everything points to a quarterly pullback in the market. Focus on that. We've seen a lot of that, and the longer term results still look intact. But there does come a point when I stop asking questions and I move on to.
Perfect. Anyone else questions for Ben? I think with that, I really appreciate your time. Always enjoy your conversations and insights. For those who want to discuss more about the portfolios that Ben manages, he is pretty instrumental within our group. He's a core component in many of our MyWealth strategies that are suitable for the clients that utilize them. But more than happy to answer your questions, spend some more time on it. And Ben, thanks again. Really appreciate it.
Thanks, Jeff. Appreciate the opportunity.
All right. Have a great day, everyone.
Thanks, everyone.